Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market Update, May 21st, 2026. This video presents a direct informational narration of the source document. All right, looking at our agenda today, we're moving sequentially right through the source document. We'll start with mega-cap tech earnings and macro geopolitics, then head straight into quantum computing funding, retail inflation data, AI and aerospace IPOs, and finally, we'll wrap up with some crucial power infrastructure deals. Section 1, NVIDIA earnings and technical analysis. So diving right into NVIDIA, their latest financial results showed a massive beat on both Q1 revenue and profit, and they even announced a staggering $80 billion stock buyback plan. But despite those headline beats, there's a really fascinating underlying dynamic going on here. NVIDIA's structural growth rate is actually slowing down compared to previous quarters. On top of that, CEO Jensen Huang essentially acknowledged conceding the Chinese market. And because the market's threshold for upside surprises is just so unbelievably high right now, the earnings report didn't really provide that catalyst for further massive valuation expansion. Crucially, we saw institutional investors heavily selling off call options, basically betting the stock wouldn't just spike higher. This structurally suppressed post-earnings volatility, rendering a lot of those short-term speculative options virtually worthless. Now, this brings us to a critical technical threshold, $230. This is the immediate, absolutely vital psychological resistance level. For the bulls to really recapture momentum and open up that upside potential toward the $250 mark, they absolutely have to conquer this specific price point. And honestly, a move like that would likely require a broader industry catalyst, like a whole new wave of global AI compute demand. Let's map out the exact technical support levels defining the downside risk here. The very first line of defense is right in that $215 to $218 range. As long as this holds without seeing high volume selling, we're looking at a healthy post-earnings consolidation zone. However, if that $215 floor breaks, there's a high probability we see a downward gap fill. That would target the $200 psychological round number, and after that, a secondary support at $196, which, as a reminder, served as a previous high turnover area. But as long as these deeper levels hold firm, the overall midterm bullish structure remains completely intact. Section 2, Geopolitics and Macroeconomic Data. With NVIDIA's post-earnings action being relatively muted, the market's focus rapidly shifted to geopolitical developments in the Middle East and how they directly impact broader indexes. And this just brilliantly illustrates the severe intraday whipsaw effect we've been seeing across equities and oil prices. Just look at this timeline. In the morning, reports surfaced that Iran's supreme leader had ordered highly enriched weapons-grade uranium to remain within the country, flat-out rejecting U.S. demands for its removal. That caused instant market anxiety over a potential collapse in ceasefire talks. But then, at exactly 1 p.m., the narrative violently flipped. Media reported a U.S.-Iran draft deal being brokered via Pakistan, sending equities soaring and oil taking a dive. Barely an hour later, at 2 p.m., Iran's president appears on state television to publicly reject any concessions, triggering yet another sharp reversal. The market was, quite literally, held hostage to headline volatility. So what does this all mean for the bond market? The latest FOMC minutes revealed a notably hawkish tone. They expressed a readiness to keep rates high if inflation persists, completely scrubbing their previous dovish rate cut phrasing. Yet, in stark contrast to that, Treasury yields actually continued to fall. This tells us the market had already fully priced in the Fed's hawkish stance, while near-term hopes for geopolitical stabilization eased fears of an energy supply shock that effectively lowered the perceived probability of further rate hikes in the short term. Applying these macro forces to the Nasdaq, let's take a look at the QQQ technical levels. The QQQ continues to ride its upward trend line as all these tech earnings get digested. That May 14th peak of $722 is acting as our primary short-term resistance and a potential high-level consolidation zone. If we get a high-volume breakout there, it opens the door straight to the $730 upside target. Conversely, short-term support is resting right between $703 and $708. But the ultimate midterm defense, which aligns perfectly with the monthly moving average, sits down at the $681 to $692 level. That is the definitive line in the sand that dictates the ongoing midterm bullish trend. Section 3, Quantum Computing Sector Funding. We're transitioning now to a dramatic catalyst in the specialized tech space, a massive collective surge in quantum computing stocks, driven squarely by major government intervention. According to recent reporting, the U.S. government is planning a $2 billion funding allocation into the quantum sector through grants and direct equity injections. The breakdown here is super fascinating. Tech giant IBM is going to absorb fully half of this, taking $1 billion. That remaining $1 billion is to be distributed among various smaller quantum firms, which equates to roughly $100 million each. And here is exactly why this matters so much for market valuations. For these small-cap, cash-burning quantum companies, a $100 million injection isn't just working capital. It effectively acts as a state-backed guarantee. This totally eliminates the systemic, short-term bankruptcy risks that were aggressively suppressing their stock prices. Furthermore, because we are talking about small-cap stocks with very low institutional float, even a tiny fraction of capital rotating out of massive AI or semiconductor stocks is more than enough to dramatically propel these quantum valuations upward. Section 4. Walmart earnings and inflation. Shifting gears from future tech to traditional retail, let's examine Walmart's Q1 financial results and their really vital macroeconomic implications. Walmart's metrics were solid, though they lacked massive upside surprises. Revenue grew by 7.3%, beating expectations, while adjusted EPS landed right in line at 66 cents. The real standouts, though, were in their optimization efforts. E-commerce jumped 26% year over year, and their high-margin ad business surged by an incredibly impressive 37%. But here is the critical macroeconomic takeaway from their earnings call. Management explicitly noted that they chose to absorb a 2.5% jump in elevated fuel costs rather than pass them on to consumers. Now, while this impacted Walmart's immediate EPS upside, there's a much broader implication here. By eating these costs, Walmart artificially kept broader inflation from printing even higher. However, the CFO warned that fuel challenges are persisting or may even worsen in Q2, which strongly signals that upcoming national CPI and PPI data prints are highly likely to be heavily pressured by these rising underlying costs. Section 5. AI chips and SpaceX IPO. Let's pivot into the rapid developments within the AI hardware ecosystem. Obviously, there's an ongoing effort to break NVIDIA's absolute monopoly. Reports indicate OpenAI is in secret talks to rent servers powered by Microsoft's custom Maya chips. While Maya is currently deployed in Azure to lower internal Copilot costs, it's worth noting it did suffer delays last year. Contrast this ambition against the harsh reality of NVIDIA's dominance. NVIDIA maintains a full 10-year lead with its CUDA software ecosystem. To illustrate just how sticky this is, the prominent AI firm Midjourney reported a severe one-year research setback due to compatibility and performance issues when their team attempted to migrate away from NVIDIA over to Google's TPUs. Breaking this moat remains a monumental task. This brings us to a massive upcoming liquidity event, SpaceX's planned NASDAQ IPO, which is targeted for June 12th. SpaceX is seeking a staggering valuation exceeding $2 trillion, with a plan to raise up to $750 billion. Let's be clear, an IPO of this unprecedented scale could severely test the broader market's liquidity and its ability to digest high-valuation tech, potentially siphoning a massive amount of capital away from other sectors. Let's break down the actual financials detailed in the IPO prospectus. SpaceX projects $18.7 billion in revenue for 2025. Starlink really acts as the core cash cow here, expecting $22 to $24 billion in revenue by 2026. However, the drag is AI. xAI reported a massive $6.4 billion loss last year. That specific loss actually drove the overall company to a $4.94 billion net deficit. Interestingly, the filing also reveals a massive $40 billion total compute procurement agreement with OpenAI. Though, it's important to note, this contract includes a 90-day cancellation clause for either party. It seems the IPO fever is highly contagious. Reports indicate that OpenAI is rushing to prepare its own near-term IPO filing. Meanwhile, their primary rival, Anthropic, is fundamentally shifting the whole industry narrative. Anthropic is actually projecting its very first profitable quarter, boasting expected quarterly revenue of $10.9 billion and an estimated profit of $560 million. This marks a truly crucial inflection point, where the entire AI sector transitions from narrative-driven hype to actually proving out sustainable, profitable business models. Section 6. Intuit Earnings and Power Deals. We'll conclude this explainer of the source material by looking at a severe software sector contraction and the physical infrastructure required for the future. Tech software giant Intuit experienced a brutal 20% stock plunge on high volume. The catalyst? Well, their core TurboTax revenue grew by only 7%, which missed the 8% estimate. But the deeper structural issue revealed by management was a 17% workforce cut, executed specifically to pivot resources toward AI architecture. Management flat out admitted they are facing severe pressure as free IRS tools and emerging AI tax alternatives actively erode their long-held monopoly in the low-income, do-it-yourself tax preparation market. This resulted in a brutal repricing of the company. Into its forward PE ratio, that's the premium investors pay for future earnings, completely collapsed, dropping from a historical tech premium of 30 times forward earnings all the way down to just 13 to 14 times. Looking at the technicals, if the stock continues to slide, $300 represents the absolute critical psychological defense line. If that breaks on volume, it exposes a massive gap down to the long-term bottom support near $280. Conversely, a technical oversold bounce targets the $342 to $347 range. Finally, to tie everything back to the ultimate bottleneck for the AI revolution, power. A new agreement between an unspecified company and NBIS secures a massive $2.6 billion maximum service fee to guarantee between 250 and 328 megawatts of power capacity to support future AI electricity demands. It perfectly illustrates the physical realities of this tech boom. And this brilliantly leaves us with a critical question to consider based on today's data. With AI demanding unprecedented levels of electricity and compute, are we underestimating the immense physical and capital infrastructure required to actually power our digital future? Think about that, and we'll see you in the next explainer.